Well, it's been anything but a quiet summer when it comes to U.S. Financial markets. We've got the trade wars between U.S. and China, slowing economies, inverted yield curves, and policy uncertainties. They've sent equity markets on a wild ride. So is the global economy hitting its KerPlunk moment? Beata Caranci is chief economist at TD Bank Group, and she joins us today to tell us exactly what she means by the KerPlunk moment. Thanks for coming in.
Oh, my pleasure.
So I have a report in front of me. I'm just going to let people see this. It does say right here, the KerPlunk moment. What were you talking about when you said that?
Well, first, you have to go back into your childhood memory to remember this was a game that you had a cylinder, you had sticks going through it and marbles sitting on top, and the idea was to pull out sticks, and the person who dropped the least amount of marbles into the base won. And eventually the base becomes so destabilized that all the marbles fall through. And the reason I thought it was an appropriate reference to what we're seeing today is we've had the base eroded with sticks being pulled out continuously for 2 years on the trade front. It started steels and aluminum tariffs, and then NAFTA, which in retrospect seemed like the easier negotiation of all the trade deals.
Who would have thought?
I know, because you had a pre-existing trade pact to work off of, which you do not have with China, you do not have with the EU, you do not have with Japan. And so this is now all the rotation of risks that are lingering and worsening. We just had the recent escalation in tariffs to take effect September 1st, first tranche, and another one in December. And so what we've been seeing is the business sentiment steadily erode, and we're getting this captured in ISM indicators, which tell us, what's your intention to invest and spend and hire. And it first started really in Europe where it was eroding, and now the US is starting to catch up to those sentiment indicators, specifically in manufacturing, but bleeding out to other sectors as well. So the notion of that paper was basically to say, this last pull on the straw, which occurred with the August 1st tweet by Trump to say we're going to do another round of tariffs, really seems to have destabilized the market more than perhaps the administration was expecting. We've seen a 50 basis point drop in the 10-year yield since that period. Clearly, the market is bracing for impact on this one because the trend is not our friend, a very famous market adage, and it doesn't look like there's any off-ramp on the trade side. So we keep getting layers put on and no indication of where we're going to get off this train.
So is it the KerPlunk moment? I mean, I think that's the thing. Is this a wait and see? Because again, you've destabilized the base. You're absolutely right with everything that's been going on. But do you think this is it? Does this tip us into recession?
So the economic data is holding in, but it's looking a bit more fragile than it was even 3 months ago. The financial indicators have certainly deteriorated in terms of the yield curve inversion on the 10 and 3 month. It hasn't happened on the 10 and 2 year yet for the US, but it's literally separated by 1 positive basis point. So you do need more depth than just 1 basis point for it to signal recession. So we are concerned. But it's one of these questions that you'll know retrospectively, it's hindsight, whether this was the straw that did it or not. So what we're suggesting is that don't ignore what's happening in the financial market. It is a warning signal. It does argue for the Federal Reserve to cut rates again in September, and we think one more time after that to try to stabilize this market.
A couple things you brought up in the report that I thought were fascinating, and you talk about cutting rates. Which again, if you're looking to say buy a house, is a good thing, in terms of the lower rates. But you actually say in your report that for every 100 basis point move in mortgage rates, the sensitivity of demand for homes is roughly 1/4. So we're just so used to it now. It's like, what's another rate cut? Like, it's not incenting people the same way it used to.
Yeah, and so this is a relationship that has become more muted post-financial crisis. It's specific to the U.S. We don't have this experience in Canada. We remain very motivated by lower costs here. But in the U.S., the scarring effect of the financial crisis, which was, the epicenter was the housing market there, where some folks are still trying to recover from the losses. We're not seeing that lower interest rates incent the same amount of demand in sales. So we've had about 110 basis point move down in mortgage rates, the 30-year conventional rate, in about 8 months. That would normally mean you would get a demand impulse of about an 8% growth in home sales, and we're only expecting about 2%. So it does help. It does put a floor, but it's not going to give you that big oomph that we've been accustomed to prior, or certainly if you're Canadian, you're accustomed to seeing.
You also talked about, I think that, and I've seen elsewhere too, that consumer spending is what's kind of propping things up. But the capex from companies, you're seeing, people are spending, but companies are not. That's worrying.
Yes, so the companies are being certainly more cautious, and there's 3 areas of investment, 2 of which are flat to down, and 1 that's holding up. So basically equipment spending and non-residential structures, so buildings are actually quite weak, and the intellectual property is doing quite well. That is only 1/3 of total investment. So you have a strong base, but only within 1/3 of your total investment, and that 2/3 is overwhelming the results. The IPP, we call it IPP, intellectual property. This is an area that we think actually did benefit from the tax cuts. It is a harder area to get funding for. You don't always necessarily have assets to back it. So it may be still benefiting from that upswing, but the other 2 components have weakened, which makes sense because your outlook for demand is very uncertain at this point.
The other thing that really caught my eye, I'm feeling so dismal and picking all the bad points in this, but you say that, again, we see the CapEx, as you mentioned, you've got that third foundational base, and consumer spending remains strong. But if companies get to a point they're like, yeah, we don't need to hire anymore, that's scary.
Yeah, so the consumer spending profile is ultimately going to be dependent on what's happening in the job market, and those decisions are made by businesses. And so far they're showing ongoing hiring intentions, and we're still seeing decent numbers coming out of the US, and that's a savings grace because the consumer is 70% of the economy. In fact, in the US, the consumer is a larger base of the economy than most advanced countries, larger than what we see in Canada, in Europe, and elsewhere. So it is the linchpin that we want to keep going in the US. There is a warning sign coming through. What we saw in data that came out last week is that hours worked is decelerating. That is not a good sign. That could be because, 1, you're hitting this topping out in the market. It also is generally a leading indicator of a down cycle. So we're not at levels that are red flagging it for us. They're still growing, but the deceleration, again, the trend is not our friend, right? So this is another piece of data where it's giving us a little bit of a cautious sign. If anything, collectively, the data is telling us we're going to hit a slower period in growth. It doesn't necessarily tell us recession, though.
One thing we have as well, we've got a chart we can bring in here that's showing that economic uncertainty is at a high right now, and we're seeing right here a couple of things, seeing China and U.S. Plotted on the graph here. Is there any way that the U.S., we're seeing, you said, some data that shows a bit of a slowdown. Can it decouple from the rest of the world, or are we beholden to what's happening? Or not we, the U.S. beholden?
Well, it's actually interesting because the relationship is that the U.S., if the U.S. hits a very weak pocket, it goes out to the global economy, not the other way around. So if Europe is in recession, that does not mean U.S. will be in recession. The financial and economic linkages go U.S. out versus in.
Got it.
So that's really important that really the U.S. avoiding recession is within its own powers, whereas if it was the other way around, Europe would be automatically adopting what's happening from that point. Countries like Germany have their export to GDP ratio at 50%. So they are very, very, and this is an economy that we think will be in a technical recession this year. They contracted in the second quarter, and the third quarter looks the same. So they're an economy that's highly susceptible to what's happening around them, and with trade policy uncertainty and China slowing in other countries.
What is it going to mean for, sorry, I didn't mean to interrupt there, but in terms of, you say the Canada, or what happens to the States, it radiates out. We're next door. So how are things looking for Canada?
So this is interesting because relative to the rest of the world, the U.S. growth profile is much stronger, what we're seeing in Europe and elsewhere. So Canada's export market is benefiting from that close tie on that front. We don't have a lot of our shipments headed towards Europe, and less so these days to China. So the fact that the U.S. is a growth outperformer is to our advantage, and we benefit from that standpoint. We're also at a point that, in terms of our own growth profile, we had very, very weak economy in the fourth and first quarter related to the housing market and the energy sector. And these are self-inflicted wounds on the policy side. We are now on the other side of that. So it's in the rearview mirror in terms of the worst impacts. We had oil curtailment that is now easing. We have the housing market rebounding back. So we're getting this domestic impulse coming through, well-timed in the second quarter, where we think we may have growth as high as 3% in the second quarter. I know it's not going to be sustained because there's a little bit of this impulse from the weakness prior, and it'll start to normalize. But we are in a little bit of a different cycle from what we're seeing globally. And part of that is because we don't have as strong trade ties out.
What's going to happen then, I guess, if you consider or continue to see the Fed cut, Bank of Canada, doing something, but not as much, obviously, as the Fed. You've got elections coming in Canada. When you kind of look out, how are things looking for the Canadian economy?
So we think, well, this is really highly dependent on what happens in the U.S. because, like I said, if the U.S. radiates out, more so for Canada. So the fact that the Fed is cutting is putting a floor under their economy, which ultimately helps us. The Bank of Canada has been completely silent since their meeting in July. So we will, as of next week, have gone 6 weeks without any communication from the Bank of Canada. So the last we heard from them was that there was a little bit of reluctance to jump on the rate cut bandwagon, as we've seen other countries do, in part because they're importing lower yields from the U.S. and elsewhere. We've seen our yield curve come down quite a bit, and because we're seeing a housing market rebound and they have to balance off these risks. So they haven't taken the precautionary stance that the Fed, doesn't mean they won't, but they just haven't yet. So this is why the markets are only pricing in about 30, 35 basis points in cuts for the Bank of Canada, whereas they're pricing in a full 100 for the Federal Reserve. And it's one of the few times you see this big dichotomy between these two regions. It also argues that there's this understanding that there are some underpinnings here on domestic demand that remain favorable, and we are somewhat insulated to what's happening in Europe and elsewhere right now.
Final question, so I don't want to keep cutting you off, but final question just in terms of the yield curve. I mean, we haven't talked too much about that. We're going to be talking more about that, but obviously that caused a huge market sell-off when people saw the curve invert. I mean, it has before, but as much as it has. What do you make of that? I know it's not the only indicator of what's coming, but it is an important one.
I agree. It is an important one. Central banks often will say, oh, we're not going to put a lot of emphasis on it because there's some distortions that may be related to asset purchases in the past, regulatory requirements that create demand. Fine. All that matters in terms of the yield curve is what the markets believe it means, because this is where you get the effect of sentiment taking hold and behavior altering based on that.
Your previous report.
Yes, this is it. So to me, it's an important indicator. It's one of the reasons why I think the Fed will continue to cut, because if they don't, you're going to get a stronger inversion, which is basically the market saying, hey, we think you're making a mistake. We think that your policy rate's too high, and it's going to choke off growth more than we're expecting. And so you'll see the behavior start to come through.
Final thoughts for Canada. I mean, you just mentioned some pockets of things that are recovering. I mean, in terms of the currency and where you see it going, any prognostications on the loonie?
So the loonie's interesting because we're not necessarily gaining against the U.S. dollar, but we have been gaining against other currencies. Again, it's showing the difference in what's happening. Interestingly, because the markets are pricing in so many cuts for the Fed relative to the Bank of Canada, that spread narrowing should be pushing up our loonie. Right? So it makes it look more favorable to invest, but it's not happening. It's just holding us stable. But when you look at other countries, we're actually appreciating. So this is what's called, when you get to the Canadian dollar, that you're basically range bound. There's not a big impulse to push you in either direction, which keeps you at around 75, 76 cents.
Interesting times. Beata, thank you very much.
My pleasure.